I'm very excited to moderate this panel, just because we are seeing a lot of work, a lot of synergies and interest in this space where investors and multi-strategy funds are looking into the litigation funding space, looking into investing it as into new asset class. And I thought it'd be interesting to have a panel on this to look at different angles and perspectives and at the trends that we are seeing for those investments. So I'll let my panel introduce themselves.
Hi, good morning. My name is Robert Hanna. I'm one of the co-founders of Augusta, a commercial litigation funder.
Hi, I'm Chad Clamage, principal at Victory Park, focusing on our legal finance strategy.
Hi, I'm Sarah Johnson. I'm co-head of our litigation investing strategy at the D.E. Shaw Group.
Nick Moore, director in Aon's litigation risk group.
Perfect, thank you. So my first question to funders on my panel. So maybe if you talk in general about sort of the nature of your fund, what are your investment criteria, how are you looking into this space, and what attracts you in litigation funding as your asset class?
Hi.
Sarah? Sorry.
Go ahead.
So the D.E. Shaw Group is a global investment and technology firm. So we have about $60 billion under management and a variety of different investment strategies that's in a lot of different asset classes and disciplines. So I guess maybe the first point is we do not focus solely on litigation investing. We're one of multiple strategies at the firm. My background is actually in distressed credit. I spent the first, 12, 13 years of my time at D.E. Shaw in our credit opportunities group. About 5 years ago, we launched litigation investing. So we're based in the U.S., mostly U.S. attorneys, formerly mostly litigators. And we look at, sort of across different types of litigations, focused on commercial litigation, but, we've done sort of claims trading. We've looked at class actions, antitrust, what we would call mass torts. So it's a variety of different litigations we look at. I guess our approach to this space is to try to be flexible and creative with structuring. In terms of investment criteria, I would say the first thing we look at is the strength of the case, the merits of the case. Also focus on damages, ability to pay, likelihood of settlement, and time to recovery. And I wouldn't say lastly, because it's one of the most important things, is the alignment with the claimant, or the plaintiff. I'll let Chad chime in.
Yeah, sure. And that's interesting that, so Victory Park is a multi-strategy asset manager focused mostly on private credit, in particular asset-backed lending. One of our strategies is legal finance, and we take a credit-like approach to the asset class. Our approach has been to find funders that we feel are best in class, that can help grow a network that we've put together. And we structured JV relationships, equity investments, credit facilities, and that way, create a network that lets us invest into the asset class. Also creates, sustained deal flow over time. In terms of our, what's interesting to us, I think it is law firm lending, and also more diversified exposure if we're taking single case risk. So we, for example, are not going to be doing the type of investments that you had just mentioned, where there's an aspect of binary risk to it. We're looking for more credit-like, I would say, opportunities where we feel like there's principal protection, there's current income generation. We're not targeting the same IRRs as a lot of funders in this room, and not going to take the risk of 4x return if things go well, but a 0 if they don't.
And just to sort of push a little bit on this, so what attracted such multi-strategy funds as yourselves into litigation funding as an asset class, and why you started looking into this over the years? How does it compare to other sort of products you invest in?
So for us, I mean, obviously, and I feel like I'm preaching to the choir here saying that it's an uncorrelated asset class. So for, pension funds, endowments that are looking for a balanced portfolio, it makes sense to have a certain amount of investments toward uncorrelated assets, and we feel that litigation finance is a strong opportunity. I'd say also, within the United States at least, law firms have traditionally just been missing the entire right side of their balance sheet. There's restrictions on equity ownership. Banks haven't really lent to plaintiff firms, especially firms on contingency fee models. And that for us creates interesting pricing, interesting opportunities on a risk-reward basis, a demand for capital that wasn't being met by the supply. And that's why we decided to enter the asset class.
Thank you. And Sarah, is it similar for you?
Yeah, I think that is similar. I think the two things that sort of drove us to look at litigation investing was the attractive risk-adjusted returns, which I think we'll probably get into a little bit more in a moment about what's happening in the larger market and credit space, and the non-correlated nature of the asset class, especially at a multi-strategy firm. It's very interesting to have different strategies that are not correlated with the other strategies, and it also I think we do a lot of we apply a probabilistic lens to all of our investments, including litigation, and so it's complex. I think many pieces of this are sort of highly subjective, but we think it sort of plays into our strength of analyzing complex situations.
Thank you. And Robert, just wanted to ask you to comment, I guess, on the flip side, what litigation funders are looking at when they're looking to raise funds for their investments. Why do you think it's an attractive asset class that can compete with other asset classes for multi-strategy firms, and how do you also go about raising funds in this space?
Okay, before I answer that, can I just tell you a little story? I woke up this morning, went to the tube station, which should have been open, it wasn't. Then decided to go to the train station, that should have been open, it wasn't. I tried one of those little electric bikes, but apparently you need a key for that, so I couldn't get that to work.
Hope we'll get a photo of that.
Definitely won't. So I ended up on a bus, and I had a 45-minute journey on the bus, which I wasn't expecting. And I thought, how lucky am I? I'm coming to the preeminent litigation funding conference, certainly in London, if not the world. And I'm going to be speaking to 400 plus people. And the vast majority of you are going to be like me, and you want this litigation funding market to be a success, and we want it to grow. And so I thought, well, that's interesting. Is it actually growing, or are we just all talking our own book? So then I thought, what are we actually doing as litigation funders? And we've mentioned this morning that we are providing access to justice. And I think that's a phenomenal point that we do, and I think it's really, really, really crucial, and hopefully it will continue to do. Unfortunately, what are we really doing? We're providing liquidity. We're providing liquidity to corporations, most of who have large amounts of capital themselves. And I think that's, when you look at the economic environment that we're in at the moment, and we had a little chat a week ago about deciding what we were going to talk about today. Well, the whole world has sort of changed in the last week, which is a little bit scary. But essentially, liquidity is going to be king. So, again, I will be speaking my book, I suppose. I think there isn't a better time for litigation funders. People do need liquidity. People do need to see whether this is something that is fairly priced to them. Again, we're an option, no more. If we are fairly priced and they think they're going to use us, then that's what they will do. So, still coming back to answer your question, I think the demand for litigation funding has never been better. I think we're fortunate we have, and certainly at Augusta, we've been lucky we've had some very high quality credit investors, such as yourselves. And you guys are really, really smart. Sorry, I said I wasn't going to say that, but you are very smart.
I appreciate it.
And you look into what we do, and you're the reason that the litigation funding market has got off so well, I suppose. My view, though, I think that's still very important, but you are going to get a wider investor base coming into the market. You are going to get the pension funds. You are going to get the foundations. You are going to get the family offices, and they've already started coming. And for us, we thought, well, that's great. Why don't we set up a product that allows these new investors to come in? You start speaking to the investors, and they say, I like litigation financing. Why do you like it? Well, the returns are uncorrelated. I would actually argue that they're negatively correlated, but that's a different story. They also say the returns can be quite attractive, which I think is good. But then they said, we're just not sure of the risk. And that's totally fine, because these are new investors coming into the market, and they don't have the resources that the credit funds have, so they can't get down deep into every investment that we make. So that got me thinking, and then, of course, we thought, who can supply the answer? And then it's people like Nick and the insurance world. And these guys have been involved in litigation funding initially on the ATE side of the business, and over the years they've realized what the true statistics are. They see more data than anyone else in the market, and so they can price a capital guaranteed product. And I think that is one of the great developments. It allows new investors to come into the market, investing in this weird, sexy asset class, knowing that they can do it in a protected way. So getting back to your question, and I hadn't forgotten. So how do we see investors? Well, it's interesting. You get people who want to come into our standard fund, which is a diversified pool of mixed cases, and great, they come as a LP investor, and that's fine. You get other people who want to get into litigation funding, and they need the protection that insurance products can provide, which is great. You also get people who want to invest alongside us. So they look at a litigation funder, they will see that the litigation funder has done their due diligence. Typically, and I'm sure it's pretty much the same with all of us, we have to see 100 cases before we invest in one or two, which is incredibly irritating, I suppose, but just the way it is. Then we'll do our due diligence, then we'll make the investment, and then sometimes, particularly now, we are seeing bigger cases. If a case is over 20 million, we may well need to go and get co-investors come alongside. So you also get co-investors who come in knowing that we've done the due diligence, they can benefit from that, they can read our investment papers, and then they'll come in alongside that.
Interesting, and I guess following up on the role of the insurance that is in the market, Nick, maybe you can comment before we sort of drill into more specific structures and products in general, how insurers look at the litigation funding market as well, comparing to insuring other non-litigation markets, and sort of what trends you're seeing there.
Absolutely. So I think if you step back and think about sort of the macro proposition of litigation finance and what that offers to investors, as Bobby says, it's an asset class where which offers high investment returns, high IRRs, and those are attractive in their own right, completely uncorrelated, as you say, Bobby. In addition to that, portfolios are idiosyncratic, so the merit of one case will not affect the merit of another. And the fundamental backdrop to the asset class, I guess, is in addition to offering investors headline returns, it offers very interesting structures. And I think if that can be put to insurers in a way which is digestible and understandable, then there's a lot to like from an insurance perspective. And we're seeing that at Aon from our client base, who are now asking us how we can help them use insurance capital within funding structures and more generally on litigation risks, and for a variety of reasons and motivations. To answer the question about the market in general, I think insurers tend to fall into one of two buckets. Those, firstly, who institutionally will not support litigation investors because they've got concerns about conflict of interest, moral hazard, or simply have kind of pretty firm views about what insurance is there to do. And then others, and I think this is increasing, who are, I guess, accepting that the litigation finance space is growing exponentially, and they understand the motivations and reasons for litigation investors wanting to use insurance capital, whether that be to, and we'll come on to it, unlocking economics in capital raising, so via kind of principal protection or what we call capital wraps, or to assist funders or other investors in locking in value with respect to successful portfolio positions, judgment preservation policies. And there's quite a lot of interesting things that can be done around what we call insurance-backed monetization, and we can come on to that, or simply to manage costs through ATE. But I think probably where we're at now is that we're past that sort of tired conversation of insurers not wanting to participate in the space because they've had this historic concern about, I guess, facilitating the seat at the casino. And our job as brokers is to explain to the insurance market why these risks are good risks, why they've been well underwritten on the funder side, and why insurers should be participating in them and putting up capital against them. And so I think we've probably got two industries where historically there's been a sort of slight mutual kind of cynical disregard. Those two industries now are coming together and achieving some pretty interesting outcomes.
Thank you. And now sort of to drill and zoom in into UK and European markets. So Sarah, wanted to see what are your thoughts as a US fund on the UK and European litigation funding market. How does it compare to the US market? What deals you're seeing here that are attractive? And what are the main challenges for funds like yours in doing deal in the UK?
Yeah, so I mean, I'll go back to maybe the starting point, which is where, our team is mostly comprised of US lawyers. So we don't necessarily have the expertise in the UK and Europe in terms of the legal system or the sort of historical precedent of how deals have been done. So we also have mostly partnered with other funders, which is a bit of how we launched in the US as well. So we're working with people that do have the experience in the UK, and I think we've already touched on this a little bit too. It can be for a variety of reasons that we're brought in, whether a deal is too big for a UK funder to do it on their own. Maybe they have different concentration limits. Also, I think we've heard today about some of like the newer developing areas of law, and what I might say are perhaps the riskier investments with some of like in CAT or other group actions. I think that's attractive because it's new and it's growing, and it seems to me like the market and the demand for funding is growing in the UK, which is an attractive component of the market to us. But also, it's pushing a little bit on the risk curve because we're still waiting for decisions and some clarity around it, how it's all going to work. So I think there's many reasons that we might come in and partner with another fund. I think although we come with a US background, obviously there are some parallels between the US and the UK system. So I think there's some familiarity there. And it's also helpful that, litigation funding has been around in the UK for a while. So there is a general acceptance of it and demand for it among sort of the entire legal system.
Thank you. And Chad, so I guess same question, but maybe with a little bit different angle. We do a lot around running debt raising and fundraising, and we're definitely seeing lots of interest, including from US funds, European funds, into entering this space in the way that Sarah discussed, partnering with another funder or doing law firm funding, as you mentioned previously. And it's still, we're seeing lots of sort of, challenges and hurdles that have to be met before this actually converts into a deal. So I wanted to ask you to maybe comment on those challenges and things that, you've seen that were attractive and that worked, but also deals that haven't worked, and sort of what were the reasons that, some deals were less attractive at the end after due diligence and you spending actual time on it? Sure.
So I guess we're in a similar position as you, where we're U.S. based. I'm I think unique at Victory Park in that I was a former litigator, but everyone else there has more of a finance background. We've invested into U.S. litigation. We know the system, and for Europe and the UK, it's something different, right? So there's an opportunity cost, obviously, to study the opportunity, understand it, and also, frankly, in the UK, it's a pretty competitive atmosphere too. So for us, we've looked at opportunities. They haven't been the right fit for various reasons. We're in active conversations with several opportunities, but for me, I could see the partnering with someone model where you leverage their expertise. The other question that I would have is how is this opportunity coming to us, when you guys exist? And is there something that can grow, our network? And then I guess the other point too is, with the riskier cases that you're talking about, that's just not the risk profile that we're looking for. We're looking for more of a credit-like return profile. So that's not the type of investments that we would be looking at.
And sorry, just to push a little bit more, so what were probably the additional factors that didn't work from the US perspective? So I know for some of our US clients, and it's very interesting to see, the attitude or approach to disclosure, confidentiality, or due diligence of merits of the claim is very different. So the parties are really coming from different angles in this, and then there is a disconnect that, sometimes we can work around, and, sometimes it sort of stops the deal. So any sort of those specific reasons that certain deals became less attractive after due diligence, or those structures that didn't work as well, both on portfolio financing or law firm financing, or partnering with maybe another funder or another partner?
I'd say more just the merits of the investment, digging in, looking at what returns have been, looking at the tail risk of, you could have a portfolio of however many cases and they might produce great returns, but 30% of the portfolio remains outstanding after 5-7 years. That drags down returns. And there hasn't been as much equity, I would say, in this asset class as in others. And so that's something that we have to think through as a credit investor.
I'll just chime in to say I agree with that. I think that one of the things that has probably caused us not to invest in deals has been duration, how long it's going to take. Everything else, all the other boxes are checked, but we just think it's going to take too long. And then that ties in maybe a little bit with like size of damages and uncertainty around the ultimate recovery. And again, like you maybe you like the merits, but you're just not sure, especially in the cases we're looking at where there is more binary risk. I think you really have to believe in significant damages as well, so that when you look at the portfolio overall, it's going to work out and you'll get the returns you're expecting.
And Sarah, can I ask, what's the sort of duration you're comfortable with? Is it 3, 4, 5 years, or?
Yeah, well, I mean, I suppose probably true for most of us, which is, like a 2 to 5 years is probably great. I think we've seen things where it could be 7, 10 years. And I think that's just, it's hard to have, it's hard to have a tail like that on a book.
And do you think if we get a proper, efficient secondary market, that could help you?
I think it definitely could help. I mean, some of the cases we've come in I'm thinking more in the US now, but they've been in litigation for, 10 years, and we come in later. And I think the secondary market could do the same thing. People are maybe getting paid more for taking it in the early days. It de-risks. You have a secondary approach. Maybe both sides can work out the duration that way. I think also, I was going to say, on the insurance products, I know there are some products that will solve for duration as well. And those are interesting.
Well, that's absolutely right. I mean, you get to the end of the policy term, it's a calculation, and if less has come back than's gone in, then the insurers true up the investor to the policy limit. And of course, there are clawback rights for the insurers, so that if these cases do go long and there are recoveries later, the insurers get repaid. But that's exactly right, Sarah, as to where these policies are really, really useful in duration risk.
But can I actually say another thing? My view is, I think litigation funders are there to take litigation risk. And I don't think, and there are some examples of this where litigation funders go and try and insure away the risk. I think that's the wrong thing to do. But if there are a number of situations like the Capital Protected Fund that we have, or where you have a case, for instance, that is above our standard maximum commitment level, where we could actually say, go and take out some insurance to allow us to take bigger positions, or you can. So I think the insurance is a wonderful tool for the market. I think it hopefully will allow us to get a bigger investor universe, and so I think.
And Nick, maybe, yes, thank you, Robbie. Maybe you can comment in sort of more detail on those different products available in the market, both at the level of investors, so like investment protection that Robbie mentioned, and also at the level of litigation funders and how they sort of work together.
Yeah, absolutely. I mean, just before doing that, I mean, picking up on your point, I mean, what the insurers are not there to do is to kind of facilitate investment activity where the insured funder or investor is indifferent as to outcome. I mean, that's not why they're there. And then you're in their underwriting. What they're looking at is the likelihood of the insured losing the litigation or the portfolio becoming principal impaired. And if that happens, the likely worst case damages scenario on the defence side, or the likely worst case capital loss or damages award reduction on the claimant side, and those amounts are important because they are typically used to set the retention in any policy. And just again, to your point, Bobby, the retention is there to align interest. But thereafter, I mean, the insurance market, and very much like the funder market, is using a variety of mechanisms to manage risk. So diversification within portfolios, to move away, at least at first instance, from this kind of binary exposure to the litigation outcome. Types of claims, I mean, historically, the insurance market has had a huge amount of data and now is aware of what cases are successful, what types of cases win, which don't, which go long, which go short, where you can get settlement outcomes which are favourable on an attractive time basis. Ticket sizes, as we call them, how much in a portfolio can an investor invest in any one claim. And then there is a huge amount of reliance on track record of funders. I think the market has been kind of going now for sort of 10, 15 years, and there are some interesting stats within funders on their performance and the kind of the money multiples that these players have generated. And also now, there's always going to be a pricing differential for those who reserve capital as against those who deploy. I think a historic gripe from the insurance market has been that the funders are paid an outsized amount compared to the insurance premium, but increasingly we're seeing a coming together where the insurers are willing to play, certainly in portfolios, but in return they participate in the economics above a hurdle at the back end of these portfolios if they're successful. So again, another example of the markets coming together.
Thank you. And maybe a question to all of the panelists. Do you feel that this influx of various investors and family offices and pension funds, as we mentioned, in the market, how do you see is it affecting pricing and deal terms from your sort of different angles?
Look, I think it can only be positive. I think when you deal with, again, some of the large credit funds, we certainly find situations, quite a few situations, where there are conflicts of interest, and that can be frustrating. So if you have a broader array of investors, that gives you a bit more flexibility. I think on the practical side, again, credit funds don't like paying fees. Certainly not fees on fees. So as far as a litigation funder is concerned, it's quite a strange business. You get your platform, you pay all the exorbitantly expensive lawyers, sorry Mark, to join us, but you deploy the capital and you don't get paid until 2, 3, 4, 5 years down the road. So it's quite useful to have investors who are quite happy to pay management fees. So you can get your standard management fees and then the performance fees. So I think it's a benefit to the industry, I think, having a diversified pool of investors.
And just to add to that, I think you're right. Historically, this industry has been financed by structured credit, but as we see more and more of these litigation portfolios being wrapped, that effectively makes them investment grade, which opens up a huge amount of alternative capital coming into this space, and that's certainly what we see. I think you mentioned family office type money, more institutional capital, all willing now to play if these portfolios are insured.
Thank you.
One of the things I was going to say, I think that we've seen maybe a change to the variety and sophistication of structures over the last 5 years, at least in the US. I think there used to be more of like a standard funding terms that people would put out, and I think with the involvement of more participants, people with more of a credit background, thinking of highly structuring products, we're just seeing so many different approaches, which I think it makes for a better market. I think it makes for a better match between different types of risk and different types of financing structures.
I guess from my perspective, a few things. First, with insurance, I think that it opens up opportunities for more credit-like investors to participate, and might decrease the cost of capital to a point at which one of the more pure-play litigation finance companies cannot participate at that point. So that is attractive, as an investor looking at those types of opportunities. I also do think that with capital coming into the space, you have seen an element of price competition too, where more of the traditional pure play funders, probably 5 years ago, are looking at more single case investments, and now they're trying to do more of a portfolio style structure, looking at lower returns, and that has an effect on the market too.
Thank you. And to wrap up, if I can ask each of you to comment on one or maybe two things that we need to change in the UK or European market, or the way we do deals, that would actually help converting all those interests from both parties into actual deals.
Well, I think the big issue is duration. That is the killer. You can get your smart lawyers to decide whether the merits are good. You can get your smart structures to write financial structures that are fair, I would like to say, for the funder and for the claimants. But unfortunately, we still can't control how long a case will go on for. Now, I think in the UK, I think the courts, they've had to put up with quite a lot. We had COVID, that was tough. That delayed things. Then I think the courts reacted very quickly and instigated virtual hearings. That was great, but it is still a lengthy process, and I think that's probably the biggest issue we have.
Interesting.
Yeah, I mean, I guess I'd agree with that. Duration has been an issue that we look into on investment opportunities. We try to price it and structure it so that we're effectively protected against duration by having healthy LTVs, diversified investments. Certainly, if they could speed up the court system, that would open up more opportunities.
Well, I definitely agree with the duration point. The other thing I think Nick mentioned earlier is data. And I think this is probably a very big ask, but D. Shaw is very data-driven firm overall, and the more information we have, sort of standardized information to look at, I think it could open up a lot more funding and obviously make the underwriting easier on cases. But that's a big ask.
All right, from our perspective, I think what's historically within the insurance view of litigation risk was within the context of M&A on this kind of so-called adverse judgment or litigation buyout product, where essentially there was an M&A deal, there's a bit of litigation or threatened litigation within the target that was stopping the M&A deal from closing, and so there was an insurance solution around that. But the product was very much based on threatened proceedings, transaction has to be there, and we can insure. Then the insurer appetite moved from that to there can be live proceedings, then there didn't have to be a related transaction at all. And then you flip to the claimant side of the world or the investor side of the world, where insurers are now willing to take risk in these portfolios or investor-backed claims. So I think what we have to keep on doing at Aon is to continue to grow the capacity available in the market to support this growing industry. And that's happening, right? I mean, even since I joined Aon 18 months ago, there have been new insurance carriers have come into the litigation finance world to play. MGAs are growing up all the time, and there's a recruitment from litigation firms or funders onto the underwriting side. And so part of our role at Aon is to help this market continue its activity by facilitating further capital and the insurance side come into play.
Thank you. Are there any questions from the audience? Okay, well, please join me in thanking our panel.
Thank you.
Thanks very much. And just to catch up, we'll proceed to our next panel now, and then the next break will be the lunch break. Thank you.